Hi, my name is Mike Garry, and my company is Yardley Wealth Management. And I've been asked a lot in the last couple of weeks whether it was still important and still the right thing to hold a globally diversified portfolio. And the answer to that is an unqualified yes. You should have a globally diversified portfolio. I think what's happened is people are looking at their statements and they notice in the last couple of years that foreign funds haven't done as well as the U.S. Was closed last year. They've also noticed that small cap has underperformed large, and they see how REITs have come and gone, and I think people are thinking either, hey, I'm just going to stick with the S&P 500 and only invest in the U.S., or they'll get rid of their international, or they'll do something to cut out some of the asset classes. And I'd say that doesn't make any sense. I said it's understandable. I know why people feel that way. It's frustrating to look at returns and they're not there. And but the thing is that the different asset classes all have the same expected returns. Small cap and emerging markets maybe a little bit higher expected return than the developed markets, but they have their returns at different times, and there's a lot of mean reversion. And so if they're going to have that 9 or 10% return, it's not going to come every year. If they have underperformance for a couple of years and brings things down a little bit, well, after you've had underperformance in an asset class for 2, 3, 4 years, that's the last time you'd want to sell out of it because it's going to come back and it's going to do better than the asset classes that have outperformed it. It's the way that it always worked, and I see no reason why that should change now. So in addition to mean reversion, the other reason you want to keep a globally diversified portfolio is that there's no individual asset class that you would just want to have. If you want to just have the S&P 500, hey, that's a part of an investment, but it's not the whole thing. And the S&P 500 has twice in the last 15 years gone down by 50 to 55%. So if you can handle your investments going down that much, well, even if you can handle it psychologically, it's probably not a good idea. The other thing is the other asset classes outside of your typical stocks, bonds, and cash are ones that sound or seem better than they actually are. Again, this year, last year, hundreds of hedge funds closed, even hedge funds with billionaire owners who have made a lot of money from their investors over the years had suffered losses of 20, 25, 30, 35% last year, and they've shut the funds down. Another thing that people talk about is private equity. And again, it had some years of really nice outperformance, but has underperformed for a long time now. And I would really advise people to stay away from those two things. Don't get caught up in it. And I really do think that the best thing is a globally diversified portfolio, and the mix for each individual of stocks, bonds, cash, and how much of which types of stocks and bonds really depends on the individual and their goals and their risk tolerance. But you really can't beat that globally diversified portfolio. And even if you have a year or two, like these last 2 years, where it's been relatively flat, it's still the right thing to do, and it's still better than a whole lot of the alternatives.